Hi everyone and welcome to the weekly update with me, Richard Perry, market analyst at Handtech Markets. Each week I'll take you through the key events that I believe will be driving your investments in the coming days. Now, certainly with the fact that the political situation in Ukraine seems to be slightly improving, and also Greece is no longer part of the investor concerns, it means that we can turn far more towards the economic data, the key macroeconomic drivers to move the markets. Now, it certainly looks like after Janet Yellen's testimony to Congress last week, it certainly looks like focus may well do that, may well be focusing more on the data, because once that word patient is removed from the FOMC statement, it certainly seems as though it's just sort of ticking down the clock in terms of when we're going to see that Fed rate hike. And certainly that would mean it will become very much data dependent, and the Fed watchers will be certainly looking at the key data to drive that rate hike. So that's what we've pretty much got throughout this week. We've got all this tier one economic data throughout the first week of the month, and we're certainly looking to focus on the forward-looking PMI data for the States, and obviously also that key non-farm payrolls report at the end of the week. So lots to drive the markets this week, and lots of potential volatility as well. We've had certainly the yield curve in the States starting to push quite significantly steeper, and that would suggest that the market is preparing for this rate hike that potentially could be coming up in the coming months. Currently, expectations are sort of middle towards middle of the year, maybe towards Q3, sort of September time perhaps, but certainly towards the end of this year, it certainly looks like we're going to get a rate hike from the Fed. So the economic data is the key thing that we need to be watching out for, and there's a lot this week, as I said. So how is that going to be feeding in towards the FX markets? Well, we've got the euro that's sitting currently now back underneath the 1260 key low that had been forming support over the past few weeks, and that's a key level I think that's been broken. I think that now means that we're going to be sort of moving back towards a test of that key multi-year low that comes in at $1.1098, and also with the momentum indicators starting to deteriorate quite somewhat, it certainly looks like that's the way the market is positioning. So selling into strength seems to be the way to play the euro once again. In terms of cable, it's an interesting chart, cable, because 53 big figure support continues to hold. Now that I think is a bit of a threshold between positive and not so positive on this cable chart, but the technical indicators are starting to deteriorate. We've actually seen on the dollar some key one-day reversals moving in the dollar's favor throughout a lot of the forex charts, and the cable chart is certainly one of those. And we're also getting some momentum indicators which are just rolling over now on cable, which leads me to suggest I'm not as positive as I was anymore. I think cable could be now moving in towards a bit of a more choppy trading range period rather than the rally that we'd seen previously on sterling. And also that's really been seeing through in dollar yen as well. We'd seen that sideways range play, but that's now beginning to break up through a bit of dollar strength that we're seeing in the market. We've formed support nicely at 118.30. That's now used as a base. We're now moving above 119.40, and that now has opened up the key reaction high at 120.50, and that certainly looks to be the test for this week. And also, actually, if you look at the other forex, some of the other forex majors, so that's, for example, the commodity currencies, you've seen 76 big figure hit as a resistance on the Kiwi dollar, and also the Aussie dollar coming under pressure from the big downtrend. So lots of reasons why we could be on the brink of a bit of a dollar strengthening once again. For indices, it's interesting because we've seen, as I said, the big geopolitical factors sort of start to recede. Obviously, Ukraine is no longer such an issue with that ceasefire holding. Also, Greece coming to the agreement with the Eurogroup on its debt profiling. It certainly looks like the markets are starting to focus more on quantitative easing once again, and that's certainly a big benefit for the DAX. DAX big outperformer last week, 3% up on the week, over 3%, and that came amidst the time at which the S&P 500 and the FTSE 100 barely went anywhere last week. So very interesting outperformance on the DAX. So that S&P 500, well, we're seeing the S&P just consolidating, as I said, in the last week. We need to hold on to that support around 2080 towards 2110, but it certainly looks like it's just struggling somewhat in just of late. Obviously, we're now pretty much through earnings season, so we're looking for other macro drivers, and with the market and the prospect of potential rate hike from the Fed, then that's sort of maybe coming to the point at which markets thinking that this S&P 500 had touched maybe overvalued at these levels. In terms of the DAX itself, well, we've got that strong move on the DAX. 161.8% Fibonacci projection target is the next level on the upside. 12,020 is that target. It's about 500-600 points away from there at the moment, but it certainly looks fairly strong on that DAX. You've got some nice support around that 11,000 level on the DAX. Now, in terms of FTSE, we're just poking above new all-time highs, actually, above that 6,950 level on FTSE. Not had a confirmation yet. We've not had any sort of close above that level. I'm ideally looking for a 2-day close just to give me that added assurance that I think the market is accepting the new level. Although I suppose it is breaking a higher on an intraday basis, still not yet confirmed that with a closing basis, though. But obviously the next move is up towards 7,000. But the thing I am still worried about is this rather significant underperformance that the FTSE is seeing. So in terms of gold, that is the last focus for this week, and what we're looking at is it's a strange conflicting set of indicators on gold. Now we've got this big medium-term bear market move that consistently sees lower highs, lower lows, but certainly in the last few days we're seeing a little bit of uplift in the gold price, bit of support coming in, starting to improve on a near-term basis. And I say near-term because it's not really turned around yet on the medium-term basis. You need to break through certainly the initial resistance at 12.23, but I think to confirm the move, 12.3650 is the rally through which you need to see in order to suggest that the bulls are starting to get control once again. But certainly is a bit of a conflicting views on that gold price. Also interesting the fact that gold is gold is rallying at the same time that the dollar is rallying. So that is a bit of a disconnect from the norm, and it'll be interesting to see what happens there, especially in light of non-farm payrolls on Friday. So this FX calendar that we've got this week, tier 1 data all over the shop. It's very, very significant amounts of data that we need to watch out for. You've already had the manufacturing PMIs from China, from the Eurozone, from the UK. A bit of a mixed bag, but certainly just slightly on the positive side. US this afternoon, US PMI, ISM manufacturing data in recent months is just slightly disappointed a little bit, and it'll be interesting to see if that continues this afternoon. But then on tomorrow, we've got an interesting rates decision from the RBA, the Reserve Bank of Australia, and it'll be interesting because it cut rates last month, and depending on who you read in terms of consensus, there could be potentially another rate cut. Interesting though that also Terry McCrann, the RBA watcher that actually called the rate cut last month, is suggesting that the RBA is not going to be cutting rates this month again. So that could be an interesting one on tomorrow morning. Then on Wednesday we've got the Bank of the Bank of Canada with its own rates decision. You've got stateside. You've also got the ADP employment report. ADP is interesting because some people see it as a harbinger for payrolls. Last month it disappointed, whereas payrolls came in impressively. So a bit of a maybe an anomaly, but still the ADP did not give too much of a great steer last month, but we'll see how that goes. Also, we've got the service sector PMIs across the board as well to play around with. And on to Thursday, Bank of England rates decision. No chance really of a rate cut coming so soon before the general election. Now, even if the Bank of England wanted to, it's probably it wouldn't really be able to cut rates because it would be deemed to be too political. So no change there expected. But you've also got the ECB giving its rates decision. No change again, no change expected there, but obviously we want more information in terms of how the quantitative easing program is going to be implemented. And then on Friday, we finish off this dense week of data with non-farm payrolls data, which obviously is the big focus for the week. 240,000 they're expected another month, I think it's 11th month in a row that would be above 200,000 on the payrolls, and certainly that will be the big focus. And also for the hourly earnings as well. Hourly earnings becoming increasingly interesting in terms of the market, and certainly the Fed would be wanting to see wage growth before it can hike interest rates. So hourly earnings is important on that front. So lots to go on this week, and I wish you good luck in your trading throughout the week, and I will speak to you again next week. Thank you.